The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Good afternoon, Wealth Advocates Nation. Great to be back with you. And good news, I brought not only the handsome, but the forthwith genius of finance, John Mickelson. Now, we cannot prove he's a genius, so hopefully our compliance people will be okay with that. But I think he is. He's very smart, does a great job, and we're going to ask him a lot of questions. And our topic today is a very timely and pertinent one. It's how do you do financial planning in a politically charged environment? It feels like, from my perspective, lots of politics, lots of emotions, and there is nothing more emotional than money. Would you agree?
Yeah.
I love to tell my clients, and by putting it on a podcast, it's going to ruin my joke here, but I love to tell my clients there is no more sensitive nerve in the entire body than the one that runs from your heart to your wallet. And people make emotional decisions. So you add politics to that fire as fuel on the fire, really, and you have an emotionally charged environment. So John, any feedback? How does one plan in a politically charged environment?
Well, to kind of emphasize your point, when I started in this business forever ago, I thought, all people really want is to understand logically, here's the right choice. Here's statistically the highest probability of success, and people will logically do it. That is not the case.
Yeah.
We are very emotional, and we let marketing and the media, it bleeds in. Whether we think we can resist it or eliminate it, it has its effect. It's like someone that goes and lives in the South for a year or two. They come back, you will feel that accent in their speech. Yeah. They don't think it's bleeding in, but it is. And so I think there's a lot to that in terms of like when we see these political things happening, our eyes are pulled toward those things. And sometimes they can be skewed in a way that's not necessarily disciplined or healthy.
Let's break it down just one more level than that, because I think what you're hitting on is so critical. Why do you think that elections and politics cause so much emotion and anxiety for investors?
Well, a part of it is, seeing things on a larger scale. We think they affect us on a local scale, and they do to a degree. There's no question about it. There is effect, but the problem I think is the components that really drive, especially in investing and money, there are more of the components there than just those few that we see in the markets or in the media, I should say. We get caught up in tariffs. We get caught up in interest rates and inflation. Well, those are major factors. But there's also innovation. There's monetary policies. There's geopolitical events. I mean, there's a lot of other things, and not all of them are negative. And of course, the media is always going to sell the negative. Always. They won't put any attention on the positives. And there are both. And so we have to be willing to say, okay, where do we go for information to make sure that we're looking at it from a standpoint that's balanced and logical, not emotional. Mm-hmm. I mean, think about it. When you've made your worst decisions, has it been when you're angry or scared? That is commonly when you do the worst decision making.
Flight or fight right there.
And so the idea is, how do you get yourself out of that state and say, okay, from a logical standpoint, what kind of decision making am I making?
What a great argument for hiring a financial advisor. I mean, it's impossible to be objective about your own money.
Yeah.
And so having a rational thought process and really a process-driven investment advisor is so key to that. Mm-hmm. Now, I have heard you give this answer before, but I think it's worth getting it out on the media right here. Do you think the markets really care who's in the White House?
No. And I'll say that very strongly. People always want to attribute the market went up or the market went down because of who's in office. Mm-hmm. I think they have an effect on it, no question. But we've seen good markets in one leadership and bad markets in the same leadership. And it just depends on the period. The other thing is economic policy. It's not a push a button and the effect takes place. When interest rates are changed, how long does it take before that change in interest rates really translates through the market and you really see the effect of it? And I would argue at a minimum 6 to 12 months, minimum. And I think it's usually longer than that. By the time a company says, yes, now I can borrow at a different rate. Yeah. And now I can buy equipment. Yeah. And now that equipment can produce a product or service. And now I'm going to take it to market and sell it. That takes time. That does not happen overnight. And it's funny when I hear things like I heard on the Wall Street Journal the other day, well, rates went down this month, and yet housing sales were slumping. I'm like, oh my gosh, how could you possibly have an interest rate cut and the same month it makes its effect?
For sure.
It's just crazy to think that people will believe that it's an instantaneous reaction. It's not.
Well, and it's interesting. There is a great education going on in the populace. You look at what happened on February 15th, 2025 to April 4th. The market drops 18%.
Yeah.
Because it's the first time we have ever seriously talked about tariffs. And in that same period, all those kids who considered themselves COVID virologists suddenly became global economists. And it's amazing how educated we all were suddenly on the impact of a tariff. Now, we were all dead wrong. We're all dead wrong because the market from there on out, all-time highs.
Yeah.
All-time highs. So the impact of a certain scenario, a news story, or a news flash is somewhat just a flash in the pan.
But look at that emphasis.
Long-term impact.
On what you just said, it dropped 18%. Based on what?
Right.
Emotion. There was no data to support that drop. None. Now we would say, yeah, there will be.
Investing is like gardening.
Yeah.
You put a seed in the ground, and if you sit there and pick at that seed all the time, it will never germinate. It will never grow.
Yeah.
But what you do in investing is you buy high quality, good, long-term companies, and you try to lean into markets. So when all this political noise comes out, that's what we're going to talk about next, is the political noise and how to avoid it. But when that political noise comes out, inefficiencies occur. Modern portfolio is thrown out the window.
Yeah.
And we have this tremendous inefficiency of there is a void in the market. We need to take advantage of it. So before we talk about how to take advantage of it, let's talk about preventative measures. What should we do to avoid all the noise that comes from political implications?
Well, I think one of them is what is based on emotion and one is based on data and real numbers.
Yeah.
Now, don't confuse that. Chaos and emotion will have an impact on the numbers. I mean, if people believe it's bad long enough and they pull back from spending, they pull back from investing, eventually that translates through into negative markets. It's a self-fulfilling prophecy.
It is.
So we have to be really logical about saying, okay, even if it is emotion and it does translate into negative markets, does that last? And if it doesn't last, is that truly an opportunity? And like you said, are we finding high quality companies that have a product or service that people want and need and they're well run? Well, in a bad market, that's called a buying opportunity. And we have to be logical enough to say, because it's easy to say buy low and sell high. In practicum, it's not that easy. When things are bad, it is hard to pull the trigger and say, I'm going to jump in when it's blood in the streets and everybody's crying.
Your own financial advisor. There's too much emotion in the midst.
Yeah.
But I think there's 3 preventative measures that we can look at and we can apply to any investor and make them successful through the ebbs and the tides of a moving market driven by politics. The first is you need to stress test portfolios.
Yeah.
The second thing, and we're going to talk about these individually, we need to have enough cash on hand. And the third thing is stay the course, stay disciplined. So let's talk a little bit about stress testing portfolios. What kind of things should we stress test in a holding, in a portfolio, in an estate?
Well, I think part of it is moving parts. If a market moves dramatically one way or the other, statistically, we can look and see what companies, how they'll behave. And it's not going to give you every data point. I mean, you don't know every time the way a company is going to react to a negative market. But you can say, the balance between safe money and more aggressive money, or dividend companies or growth companies, we can see there's a definite clear effect if it's a negative market, and it's more dramatic in a growth company than it is in a value company or a dividend paying company.
Absolutely.
So that's where the stress testing comes in to say, there will be bad markets. I know it. We will have bad markets. It happens. That's a natural course. The question is, when it happens, have we prepared for it?
And then one of the things that we do, we've spent a lot of money on software that will help us model out the portfolio. You often talk about financial planning firms being a lot like restaurants. We all shop at the same grocery store, but it's how we put the recipe together.
Yeah.
And one of the things that we do as part of our recipe at Wealth Advocates is we stress test it. We'll model it in different scenarios, and we can show our clients, hey, if there's an interest hike, hey, if there's inflation, what if the world burns down in COVID? We can model some of these scenarios out and show how these individual holdings will react, and collective and holistically how that'll impact your portfolio. And when we do a review, and I say this to my clients every single time, whether the market goes up or whether the market goes down, it's your plan that's important. And the functional question you should always be asking is, are we still on track?
Yeah.
And that's what your reviews are all about. It's stress testing our holdings and where we're going at. Mm-hmm. So let's talk about cash management, because politically charged environments like what we're in create inefficiencies, and we need to have cash on hand. Why? What are we doing there?
Well, when we have big growth markets, everybody hates cash. Hate it. Should be in. It should be working. When markets are bad, of course, everybody loves it.
Because we all love to buy high and sell low.
Yeah. And the key to the whole thing is to always start from, what is your priority list? What is coming down the line in the next couple of years? I mean, if you say, hey, I'm going to need funds in the next 2 to 3 years, you can't have it drop 20%
Distributions
and then
are
say,
critical.
hey, I need the money.
Yep.
So we need to know we have enough stable asset to say we can weather a storm. If things drop, I'm still on track for the priorities. Don't let the markets dictate what you choose to do with your investments. Let your priorities do it. So if you have something coming soon, yes, you do need to have some money you can rely on in case something drops. And that's where that cash management idea comes in. Mm-hmm. You need to make sure you have enough cash on hand, even if it's inefficient. It's not about the return. It's about access.
And let me draw back to a point you just made. We will typically have anywhere from 5% of your portfolio to 15% of your portfolio in cash at any given time. Now, it's in a money market account. It's not
Still
really
drawing
cash.
interest. Yeah.
But the reality is, as the market goes up and hits all-time highs and all-time highs again and all-time highs again, we're building up a cash reserve. Mm-hmm. And when the market's going down, that's when you're going to see that 5% in cash. You know why? Because I'm using the cash that I built up during all those gains and I'm deploying it on the way down, because in gardening, the most important thing is when you put the seed in the ground. And if I can't time the market. I can't. Anybody that tells you they can time the market is lying to you. But I can buy things on discount. I can look and do the math on what their perceived and projected value is. And I'm a coupon clipper. I love to buy things on sale, especially your stocks.
Yeah.
So cash management's key here. What about staying disciplined? What role can we help with our clients on staying disciplined and staying the course and keeping them on track?
I really feel like that's probably one of our most important roles out of everything. Mm-hmm. It's really the behavioral aspect of what do we do when things really get scary? Because they will. At some point, they will look very scary. And so I think one of the most important things is to look at it and say, okay, when things are bad, what is the plan? Go back to the broader perspective. Don't get caught up in the moment of the day, because people get so, like I said, scared and fearful. You've got to make sure you say, have I prepared in advance for what's happening, and how do we adjust as it goes? So that's one of the most important things is in behavior. Make sure you have a sounding board. Make sure you have someone you can turn to say, okay, here's what I'm concerned about. What do I do?
Sometimes the best way to learn something is through an example of somebody that didn't learn something. So have you ever had people not stay the course or try to time the market in especially politically charged environments?
Yeah. In fact, even the last few months, I've heard the phrase, I think we should get out until it gets better.
Oh, now that's a telling phrase.
I really worry when I hear that phrase, because if you look at any period, look at the history of the market. I have this graphic I show clients all the time, the ups and downs since 1945. And it shows all the dips and all the ups. The ups are dramatically longer. The dips are lower. But when you're in the dips, it feels like they will never end. Mm-hmm. You feel like it's going to be there forever. Now, the problem is when you go from the dip and you start to see the recovery, the best part, like there's one that shows the last, the 11 years preceding COVID. Huge, 400% return, 15.8% per year for 11 years. And that's huge. So the very best part of that whole 11 years was the 3 months coming out of the drop.
Oh, yeah.
And when people say, oh, I'll get out until it gets better, what you've just said is, I promise I will not be there for that very best part.
Yeah, absolutely. I have clients that got out of the last election. I have clients that got out at the tariff notification.
Yeah.
I have clients that got out at the bottom of COVID. And
Now,
it's
I have no
impossible to
problem.
get back in.
I have no problem with get out to make sure you have enough to weather the storm. No problem.
For sure. We never want to dip into the cash because that is rule number one. Have enough cash on hand.
Yeah. Now, that doesn't mean that when we're in the chaos of the down, that we just bury our head in the sand and say, oh, we just hold on. No, we're looking at the companies we're holding and saying, is there anybody there that has surprised us in a bad way? They haven't done what they thought they would do. Do we need to make a shift from one company to another? That's critical. I mean, that's the whole rowing versus sailing scenario. You know, when the markets are up, the wind's pushing you, everybody looks good, it looks easy. When it goes down, get your paddle out and dig in. You got some work to do. And that's really what we have to do when we see those shifts in the market.
For sure. So let's give people some action items because otherwise this is just talk. If somebody feels nervous, anxious, or afraid of what the future holds in a political environment, what should they do?
Well, they should start with defense first. Do I have the right defense in place? And that could include insurances and things like that. But what are the big risks? What could ruin your whole plan? And identify those things and say, okay, how do I make sure that I've done as best I can to minimize those risks, including the cash management? That's a big piece of that. Do I have enough on hand? Then it's be realistic about what are my real objectives? Are they going to come up in the next few years or are they 20 years down the road? Mm-hmm. If they're 20 years down the road, you have a lot less to worry about. And so I think that's the main thing. And then go back to that stress testing idea. Look at, and that's where should meet with you and say, how do things look now? How, things are better than we thought. Things are worse than we thought. How do things look now? That's so important to make sure that you feel like you know your advisor, whether it's us or anyone else, that they know what's happening and that you're staying on the plan.
Okay, so last question. When somebody comes to you and says, TikTok told me to, what's your answer?
Find the source. Is it credible or is it not credible? It's so many people want the broad, easy answer.
They do.
Go to the footnotes.
Yep.
Where did that data come from? Is it real data? So and then the other thing is does it really matter in their plan? 9 times out of 10 they'll bring something in and it has nothing to do with what they're trying to accomplish.
So true. Well, I think we've got some good takeaways here. We live in a long, politically charged environment. It doesn't seem like it's getting any easier, but there are 3 things that you can do to get through it. 1, stress test your portfolios. 2, have adequate, not too much, but adequate cash on hand. And 3, stay the course. John Mickelson,
Amen.
Thanks for joining us.
Thank
Wealth
you.
Advocates Nation, it is good to be with you. We'll see you next time.
Wealth Advocates is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of Wealth Advocates by the SEC, nor does it indicate that Wealth Advocates has attained a particular level of skill or ability. This material prepared by Wealth Advocates is for informational purposes only. It is not intended to serve as a substitute for personalized investment advice or as a recommendation or solicitation of any particular security, strategy, or investment product. Opinions expressed by Wealth Advocates are based on economic or market conditions at the time this material was written. Facts presented have been obtained by sources believed to be reliable. Wealth Advocates, however, cannot guarantee the accuracy or completeness of such information, and certain information presented here may have been condensed or summarized from its original source. Wealth Advocates does not provide tax or legal advice, and nothing contained in these materials should be taken as tax or legal advice. Please consult with your tax professional regarding your particular situation before implementing any strategies discussed. Advisory services are only offered to clients or prospective clients where Strategic Advocates and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Strategic Advocates unless a client service agreement is in place. Strategic Advocates LLC is a registered investment advisor. Please visit our websites at www.wealth-advocates.com or www.strati.co for important disclosures. Securities offered through registered representatives of Creative One Securities, a broker/dealer, member FINRA/SIPC. Advisory services offered through Strategic Advocates LLC, a registered investment advisor. Strategic Advocates LLC, Wealth Advocates, and Creative One Securities are separate entities. Wealth Advocates is located at 255 South Main Street, Suite 140, Logan, Utah, 84321.